Hey, good afternoon, everybody. This is Nathan George with Nathan George Consulting here in lovely Northeast Tennessee. I'm out of Kingsport and Tri-Cities area, but I work all over the country. I am here today with Mr. Greg Reese from Reef Point, and we are discussing the Deferred Sales Trust. And I'll just pass it over to Greg, and he can give us a little bit of background about himself and how he got started with this business.
Sounds good. Well, Nathan, thanks for having me on with you today. As you said, I'm Greg Reese. I am one of a handful of certified trustees for a very specialized and unique tax deferral strategy known as the Deferred Sales Trust. Reef Point, it really serves as sort of a professional trustee, if you will, or almost like a corporate trustee. So. And I work with the estate planning team, which is the mothership for all things deferred sales trust. Very specialized, very niche strategy. What it does is, let's talk about if you're contemplating the sale of a highly appreciated asset, which could be a business, could be investment real estate, could be highly appreciated personal residence, could be cryptocurrency, could be collectibles, could be intellectual property, anything that appreciates in value that would ultimately be subject to capital gains tax treatment upon the sale of that asset could benefit from learning about and possibly using the Deferred Sales Trust in context. It provides a very flexible and attractive alternative to such things as 1031 exchanges, charitable trust planning, opportunity zones, and the like. So it's something that's not new, but it's still new to a lot of people. Our strategy and our structure has been around for more than 2 decades, I think 27 years running now. And what it amounts to is a very specialized form of installment sales. So give you a little quick background. Installment sales were created in the IRS code about 100 years ago. So it's not even a new code section, something that's been around for a long, long time. So there's a definition of what the code considers an installment. It means that if you're selling a highly appreciated asset, whereby you intend to receive some of your sales proceeds in 1 or more years after the year of sale, that's the definition of an installment. The rule set around this is that you only have to recognize and pay taxes on any amounts that you choose to receive each year, meaning that you're deferring the bulk of the taxes until you actually need it. I'll give you a little comparison, just jump right into sort of my comparison that I like to use. Imagine you could sell your highly appreciated real estate business or other appreciated asset, and the entire proceeds of this sale go into a trust created specifically for your transaction. And that trust acts in 5 specific ways as though it's your personal 401k plan. So this is something I find that everybody has some familiarity with, right, Nathan? You know how IRAs and 401k plans. So look at it this way, because this demonstrates levels of control and flexibility. So I think it's a good analogy to use here. So imagine the sales proceeds come into this trust. And if it's acting as though it's your 401k plan for a second, think about it this way. You are the one that controls how much you want to receive each year. In other words, if you had a 401k plan and you were going to retire tomorrow, are you going to cash that thing out? Probably not. Most of us would not do that because we look at that as a tax advantage environment where we're going to pay tax on any amounts that we choose to draw out of it. And so we probably are going to be smart about this. We're only going to draw what we need and pay taxes on what we take, right? So you get to make the decisions about the frequency of withdrawals that you might wish to make. There's, granted, there should be some discipline and structure to the deal. It shouldn't just be an account over here and an ATM card over here and just randomly drawing. Usually you're going to structure some form of payments, figure out what your budget is for the next 2 or 3 years, what you need to support your desired lifestyle, and set up a payment plan from the trust to come to you. The beauty about this, though, is that it is flexible. It can change. If your lifestyle changes, the trust can change with you, so that if you need more income, maybe you're taking too much and you don't want to pay tax on that excess income that you're not consuming, you want to back it off. What if you have an emergency, you need a lump sum? All of these things are possible with the deferred sales trust. That's really the first comparison. Second comparison is really, what can the trust invest into? Because obviously, most people are going to want to replace income from that they were receiving from the asset they sold, or have other goals. So usually it's trying to increase the amount of income that I can receive, or to grow my wealth more rapidly, or maybe a combination of both, because you're not having to dilute your investment nest egg with taxes, right? So the second thing is, how should the trust invest the money? How can the trust invest the money? Well, that's another interesting thing, because there is actually no restriction or limitation on what the trust can invest into. The only limitation from our end is we can't invest any of it if you don't approve it. So you have control over the investment allocation options. So what that could mean is that you might want to be in a very liquid, diversified portfolio of equities and bonds and ETFs and insurance products and passive real estate funds and various things. You might also be interested in the opportunity to invest back into actively owned and managed real estate, or buy, sell, or start a new business, or do hard money lending on the side. These are just examples and alternatives. So really, the sky's the limit. You know, what's important is that you match up your lifestyle needs for income and or growth with the types of investments that you would want the trust to engage in, so that kind of matches up, provides that income you need, provides that growth that you need, maybe a balanced approach, income and growth. So that's really what most of our clients are seeking, income and growth. You know, they want to grow the underlying principal over time, because they'd like to give themselves a pay raise, essentially, when they're ready to. So that's the second real comparison to a 401k, because who makes decisions on how you invest your 401k plan? You do. Who makes decisions on how your DST might invest the money? You do. You're working with your tax attorney, our tax attorney. You're working with your independent trustee. And we also have a third member of the fiduciary team that supports every DST, which would be a licensed investment advisor. Both the trustee and the advisor have gone through pretty deep training, vetting, et cetera, to make sure that they're appropriately knowledgeable individuals about how to manage these things, as well as have a good understanding of the DST itself and how it works. So the third comparison to the 401k plan is kind of how you pay taxes. So much like a 401k plan, you only ever have to recognize and pay taxes on what you choose to withdraw or receive in distributions from year to year from the DST. How the money is taxed under the code section, which is code section 453, the first dollars of distributions you receive are considered interest on your note. So imagine you had $1 million sale, and let's just say, because it's easy math, that the interest rate on your note was 5%. That means that your choice to withdraw up to, let's say, $50,000 a year, which would be 5%, would be considered interest on your note. Haven't touched your principal. You're just clipping coupons. You're just drawing the interest. Now, there is no, but to the extent that you want distributions that exceed whatever the accrued interest is, then that's considered a partial return of principal, which means that there's a blend. There's ordinary income taxes are charged on interest, right? But if you're ever drawing any amounts of principal, you know, in addition to the interest, then part of that's going to be treated as capital gains. Part of that's going to be treated as tax-free return of original basis, meaning what you paid for the asset in the first place. And if real estate's involved, maybe a sliver of that would be considered depreciation recapture, right? And so, but just know that there is really no minimum or maximum drawdown that you need to make from the DST. It's wide open. It's so flexible. If you don't need any income for the next few years and you want to leave it in that tax advantage environment, you can do that. Let it grow for a bit and then turn the income spigot on in the future. So really no correlation to age, like minimum distributions. So it's not like a 401k in that respect where you have to start drawing by a certain age, or there's a minimum that they make you take. None of that applies here. So you be the judge, you set your own budget, you draw what you need, you accomplish your goals. So that's the third comparison. Number 4, legacy and estate planning consequences. I'm an old estate planner, at heart. I was a real estate professional, a financial advisor, and I started a company called AmeriState Legal Plan that specializes in estate planning, asset protection, tax mitigation strategies. And that's a 25-year-old company that still operates to this day. But so I'm always thinking about the estate planning. How does this find its way to my designated heirs, right? So the DST is like any other asset that you might own. You get to basically combine your personal estate plan with your DST trust so that it can pass to your children, grandchildren, whoever, and it can actually last through generations if you wanted it to. There is no end date prescribed in the code where this has to end. You'll typically have a note that could be anywhere up to 10 years, you pick it. But then if you like what tax deferral is doing for you, and we'll talk a little bit more about that in a second, but you can extend it. You can roll it over. You can also cash it in early, which is another important consideration. You never have to feel like you're stuck in something with no flexibility. That's one of the beauties of this. So if you find that you want to cash it out early, take all your money, there's no penalty, there's no service charges, there's nothing, it's your money. Number 1 rule here is we all have to understand and recognize that this is all your money. You could have it tomorrow if you want it. You'll pay tax when you take it, but it's no different than having money in a 401k plan. It's all your money. If you want it all tomorrow, take it. It's fine. Nobody's going to charge any penalties for doing so, except the government, because they're going to charge you some tax money when you take it out. So be smart about it, right? So this estate and legacy planning is really important in my view, because you get to decide who takes it over if something happens to you. And they'll have all the same rights and privileges that you do, including the ability to cash it out, change the payment structure, change the investment structure. Maybe they felt dad was too conservative and they want to be a little more aggressive. I don't know. But, all the same rights and privileges you have, they would have too. Last comparison really is asset protection. Asset protection comes as a byproduct to what we do. So much like, if you're aware, 401ks have fairly bulletproof asset protection, meaning that if you get sued in the future and some creditor gets a judgment against you or whatever, they're not going after your 401k plan. That's pretty well protected under law, the ERISA laws that created those types of plans. Similar protection is available for your DST. You get sued in the future, somebody's coming after you, they're not touching the principal in your DST. So asset protection comes as a byproduct for what we do. Make sense?
Yeah, for sure. Because that's huge. That way, if if heaven forbid something happens and somebody tries to, you have legal proceedings and you're like, oh my gosh, I've got this trust sitting over here, what's going to happen to it in the event something unforeseen happens, and that's a big deal. To me, that's a that's a slam dunk as far as, like you said, protecting your assets and securing those for your your children, your grandchildren, your great grandchildren. That, like you said, that can be rolled over and used as long as you want to, pretty much.
Yeah. Well, and look at it this way, what's the benefit of tax deferral? Right? Tax deferral, maybe say it a different way. If you're forced to pay taxes, capital gains taxes on what you've worked so hard for, it's like taking a big slice of equity out of your business, big slice of equity out of your real estate or other appreciated assets, and handing it over to the government that does nothing for you. So having the ability to defer your capital gains taxes at the time of sale means that you get to keep the taxes that you otherwise would have paid, working directly for your benefit. And I said it earlier, but what does that mean? That means I have more money to invest to generate a higher amount of consistent income for myself, or to grow my wealth more rapidly because, or maybe a combination of both, because I'm not diluting my nest egg. I'm not diluting my equity by stroking a big tax check at the year of sale. So that can be very, very powerful and in a compounding way, because look at it this way. I'll use that $1 million example. Maybe I'm selling my business for $1 million, and we'll talk more about business owners and sellers in a bit. But let's just say that I was going to pay 30% of that sale in taxes. I'd have $700,000 left to invest. Let's use that same 5% example that I mentioned earlier. If I had 700,000 to invest at 5%, the interest that I could take for myself is about $35,000 a year. But what if I got to invest that whole $1 million? I get to defer the tax, like keep that working for me. If I invested it at the same 5% rate, for example, that's $50,000 a year, $15,000 more every year.
Difference.
Over 10 years, that's $150,000. I don't know about, most of you. I've got kids in and going to college, so that could come in really handy for me, just to get my kids through that educational environment. But and you get to determine, how long you want that to roll. But so tax deferral could be very powerful. Also, think of this. If you sell that business, that real estate today, and you have to add all of those gains onto this year's tax return, it's going to push you into the top tax brackets. No doubt. I mean, every client that I work with, they would otherwise be, and depends on what state you live in. I mean, you may be in a tax-friendly state like Tennessee or Texas or Florida, and maybe you're just looking at 20% capital gains, maybe the 3.8% Obamacare tax, no state tax. If you're one of those fortunate sons that live in a garden state like Tennessee, but you'd still be looking at 23.8%, almost 25% in taxes, right? And so, but if you're using, a strategy like the deferred sales trust and only taking what you need and paying tax on what you take, you may only need $50,000 a year to supplement your lifestyle needs, right? That can dramatically lower your tax exposure from the federal and state level. Much lower brackets. I mean, when I do the analysis, typically people are saving 10 to 15% less of a tax bracket, which that adds up too.
That adds up down the road too, for sure.
Yeah, and the final point is, like, we're not talking about tax evasion here. We're talking about tax deferral. Tax evasion is kind of, they give you a nice room in the Gray Bar Inn, right? If you're
Right.
evading taxes. But tax deferral is completely allowed. The IRS loves it. Actually has a public benefit associated with it. 401ks and IRAs, like my example, that's a great example. 1031 exchanges where people can sell and exchange into other real estate and defer the taxes on the second leg. That's another example. So, but think about, you understand what your tax obligation is, what your capital gain is going to be. But if you don't have to pay it today, you can pay it 10 years, 20 years, 30 years down the road, based on inflation and the rising cost of goods. It's like paying today's taxes with tomorrow's dollars, meaning that they're worth a lot less when you finally decide to get around to paying them. So, there's a huge benefit for that. Just want to mention that for your viewers.
Touch on, a lot of business owners and individuals are like, I don't know if my sale could really justify using deferred sales trust. What, I know in every situation is different. Is there like a threshold that a seller might look at, be like, okay, if I do this, would it really save me anything?
Great question, Nathan. Business owners are a really unique category because most of us, I'm a business owner as well, most of us start our businesses with very little, capital up front. We're creating this business as opposed to sometimes we buy a business, so we've got some investment into it. But what I found is the vast majority of business owners that are selling, all of the sales price is taxable. because they have very little cost basis built up inside their business. We start with a phone and a computer and an internet connection, and then we fund our growth through loans or cash flow, things of that nature, where we grow it into something that's valuable that somebody else would want to buy. How great is that? And so that's a unique challenge for business brokers. So let's talk about sort of the minimum viable transaction, but let's also talk about what are your options. I work with business brokers business brokers and business sellers every single day, and they get a little panicked when they learn about the tax consequences of selling their business, to the point where some business owners feel like they can't really retire on what's going to be left over after taxes, and they hold on. They white knuckle it for another 2-3 years, try to really ramp up the the EBITDA or the ROI, in the business, and maybe going to exit later than they originally planned to. What if there was a way out that you didn't have to do that? So, they start scrambling and looking, what are my options? Can I do a 1031 exchange? Well, no, once upon a time, you could use that code section to sell a business, but not any longer. It's only viable for investment real estate, reinvesting back into more investment real estate. What about charitable trust planning? You can consider that, but you got to have that thing set up, funded, transfer ownership into this trust before you even put the sign in the ground, or it won't work. And then there's limitations and restrictions as to what you're going to do. Plus, there's the charitable component. So if you plan to leave all this money to your kids, well, you can't. So you may have to do some additional planning, cut into your income, maybe to buy some life insurance for your kids, because one or more charities that you designate are going to get the money. What about opportunity zones? That's another option that's approved in the code, relatively new, just came online, during the Trump administration. So it hasn't really been around for a long, long time. And so that means a little bit of Wild West going on out there in opportunity zones. But from a tax perspective, it can provide you some ability to defer taxes if you take proceeds from your sale and invest it in an opportunity zone. Kind of the problem with that is it's a very short window. Right now, under the current code section, you still have to pay your capital gains taxes by 2026. What is it today? 2023, closing in on the end of the year. So it's a very short-term deferral, at which time you're going to have to pay the taxes on what you just sold. But the other piece of the opportunity zone is if you hold that investment, because generally speaking, they're relatively illiquid, not that flexible, you're kind of at the mercy of the sponsor to deliver cash flow or growth or improvements. When they decide, you can't just call them and say, hey, I need more money. Doesn't really work that way. But you could potentially avoid the capital gains taxes on that investment if you hold it for somewhere between 7 and 10 years. But I just kind of find that everything's got its place. Don't get me wrong. I'm not knocking any other strategy that's available, because there's really not much the IRS has given to us that we can look at. So those are some of the options, but the deferred sales trust is probably the most flexible option that gives you the maximum amount of control and decision making, and so that you can vary things as your lifestyle needs change. So it's extremely attractive for that reason. Business owners in particular, it's probably the best option for you. So what constitutes a viable transaction? People kind of misunderstand that there's certain dollar threshold of a sale value. That's not how this works. What we're looking at is the amount of taxes we can help you defer determines whether or not the size of your transaction is large enough to qualify for using the deferred sales trust. Because, first rule is it has to work for you or it doesn't work for anybody. It can't make sense for us from a fee standpoint or whatever, but it doesn't deliver, minimum desired results for you. It doesn't work for anybody. So here's how we look at this.
Right. It doesn't solve your problem. So, I mean, we're in the problem solving, tax deferral, that's our goal. And if we can't, if it doesn't make sense for the seller or whoever, then it's, it really, that's the main driver here.
exactly right. So let's talk about what is that number. Okay, I'll say it two ways, because saying the same thing two different ways. If you would assess that selling your asset would result in you owing at least $100,000 in taxes as a result, with no particular planning involved, that would be a viable transaction. Said another way is that if the growth or appreciation or the taxable amount of your sale is at least 300,000, that's saying the same thing, just a different way. So let's talk about a business owner. We could have a business that's being sold for, I don't know, $500,000. I'll just say that's the sales price. After you pay your your business broker commissions, after you pay your closing costs, you're still going to be netting at least $300,000, which in most business sales is all taxable, because again, we have very little basis. So I'm just using that as an example. You could have a business being sold for $400,000 or $500,000, and it could still qualify for using the deferred sales trust, because don't forget, you're still going to spend, roughly a third of your sales price in taxes, right? What if you could keep that money working directly for your benefit? That would be a huge opportunity. And for the business brokers that we're, potentially speaking to today, what is the elephant in the room that you probably don't talk about, nor do most of your competition talk about, is the tax burden. That's not what you specialize in. You're there to get the deal done, get it to the widest variety of potential buyers, negotiate the transaction, and make sure it closes. Do all the due diligence and homework, right? What if you could add another specific differentiator to your transactions with your clients, and that is to help them walk away with an additional 25 to 35% greater net proceeds? Because it's not always about what the sale price is, it's about what they get to walk away with. It's what you keep that matters, right? What if you could be the problem solver? And I know why most professionals in the real estate space and the business broker and the M&A space don't generally talk about taxes, because they don't have a solution to that problem. It's just, you got to talk to your CPA, death and taxes, you know how it goes. We're all subject to it, right? So you kind of push that off and treat it like it's a fact of life. What if you were a solution provider that says, no, it doesn't have to be that way? What if you have a way to take the tax problem off the table? Now that guy that wants to retire today, but feels like after taxes, he's got to hold onto the business for another 3 years before he can sell it to try to drive the value up. That guy can rest easy in your hands and just like, I'm okay, I'm good to go. If I can solve that problem, that tax problem, and you can help me solve that tax problem, I'll list my business with you. I'll list my building with you, because nobody else is coming up with a solution to this problem. And it's a big problem. I think we all agree.
Sure.
Right?
I mean, 30% that, like you said, a million out of a million it doesn't take much to get $1 million, sale either. It doesn't take much of a business, and 30% of that is, shoo,
That's huge.
that can hurt. And just touch on for a moment, deferred sales trust is not a new concept, but in general, but a lot of people, are just now maybe hearing about this. What in your experience, would cause like a business broker or a CPA to be, reluctant about going down that path?
Great question, Nathan. The track record and history is super important, because as you said, this is not new. It's just new to a lot of people. What we're doing in our deferred sales trust is very specialized and very niche. So we really don't have dozens or hundreds or thousands of other tax attorneys trying to replicate what we do. Here's why. So during the course of the last 27 years, our tax team, the estate planning team, and our tax lawyers and CPAs really put this structure and this strategy together. It took a dozen years for the IRS to even, get their attention to want to do a deep dive. So for the first dozen years, of doing these transactions. The IRS had audited, a dozen total audits, field audits to date are only about 16, but they did their field audits, and every single transaction, which by the way, our tax team stands behind every transaction we do, meaning that if your transaction is ever audited for the life of your trust, they'll defend it for you at no additional cost to you. Luckily, it's a very low audit rate, because the IRS knows exactly what we do. They know who we are. They've done a series of field audits with different clients. Every single one of them resulted in a no change letter. The IRS has done at least 3 in-depth reviews directly with us. The first one was not until about 2008, which involved 10 years worth of transaction records and a week of personal time with our tax team and the IRS auditors in their offices in Southern California, going through all those records for about a week. They concluded at the end of that review that this was legal, conformed with the code, and they had no other, suggestions on how to improve it or make it even better. It was good to go. They reviewed it again in Washington, D.C. The last review we had directly with the IRS was April of 2019 out in their Los Angeles office. So our tax team is making road trips to come visit with the IRS in person because that's what they want. But put it into perspective. Over the last 27 years, we've done over 4,000 transactions, totaling in excess of $200 billion with a B. We have never had an adverse finding from the IRS or any state or other municipal taxing authority with regard to the legality. We have taken this to some of the top tax law firms in the country to do peer review for us to figure out if they could poke holes in it, kind of like the scientific method, see if you can poke holes in what you do. Names like Day Pitney, Venable, Aldrich, some of the top tax law firms in the country. If you ask your CPA about these names, they'd know them instantly. They've concluded also this is legal, more than sufficiently IRS proven and tested. And what we want to know from them, more importantly, is would you consider this for your own clients who had a need in this area? And to affirm, they all said yes. FINRA has done a deep dive on this. FINRA regulates and oversees all of the licensed investment advisors in the country. They wanted to do a similar deep dive like the IRS did with us because, investment advisors are helping people invest their money. It's no different with the DST, right? So they had to do a deep dive to make sure that there wasn't a scam going on here or an unlawful trust arrangement, because that would give the whole financial services industry a black eye. So as a result, FINRA approves any licensed investment advisor to invest money for various trusts that might be created out of the sale of an appreciated asset. So there's been a pretty deep track record, a lot of transactions. IRS takes a long time. What's the old saying, Nathan? Give a guy enough rope, so he can hang himself. It's like they want you to do a lot of transactions because if they come wander in and start auditing or investigating what you're doing, if they don't like it, they've got a paper trail back to all the clients that you just did this with, right? That's how the IRS typically operates. So that's the main reason why we don't have dozens, hundreds, or even thousands of other tax professionals trying to replicate what we do, because everybody's got to, walk the path and walk their own timeline. And so they would have to go through the same amount of time, same amount of transactions to try to prove up the techniques that they're using. We've already done that. So at this point, 16 field audits out of 4,000 plus transactions, it's nothing. Just random at this point. But the IRS, if they see a DST, they know exactly what we're doing, and they do follow-ups with us every few years at this point, because they want to make sure that we're not adding any new ingredients to the recipe that would spoil the milk. And so our audit rate is very low. Our tax attorneys stand behind what we do by defending any audits that could come, and it's been proven. So even your CPA will probably not likely have heard of this yet.
Right.
But once they take the time to listen and understand and start talking about the code section and how the structure works and is put together, they come around with a light bulb moment where they go, okay, I get it. I've done installment sale reporting and transactions. I understand. I get how this works. And so that's all we really need, is for them to actually be willing to understand what's happening, because they're an important advisor in your life. We get that. We want them to understand it and be on board with it to help advise you properly. So,
And
well,
I guess that's one thing that's important too, is, and not any, Tom, Dick, or whoever is qualified to do this. You all have your circle of trusted partners that you've been working with this for 27 years, and everybody communicates, and everybody's all on the same page with working with the client's needs and what their goals are. And and one thing too that maybe we could segue into is everybody's like, oh my god, how much is this going to cost me? And the business owner's like, I don't want to shell out any more money than I have to. I don't want to pay these guys thousands of dollars and not use this vehicle to get where I want to be. So kind of what's the fee structure, and does it cost anything for the customer?
Well, of course, there's always a fee involved somewhere, right? So, I mean, there's no denying. But, when we kind of go back to the earlier segment of the conversation where we talked about the minimum viable transaction, and that's based on how much taxes would you otherwise owe if you didn't have a mechanism to defer and keep those tax dollars working directly for your benefit. This plays into it. The fee structure basically falls in line with really the minimum viable transaction. So it's really quite simple. The legal fee is paid at the close. There's no upfront cost to begin with, because anything could happen. You could decide not to sell the business. The buyer could walk away. You could feel sorry for the government, feel like you need to do your fair share. Maybe you want to pay your taxes. Okay, everybody's got choices, right? So the legal fee would be paid as an expense of the trust at the end of the transaction, only if you use it. If you don't use it, what we build for you, then we just close our briefcase and go help the next customer. There's no consequence to you. But the legal fee would be typically based on the sales price, and it'll be a one-time fee of 1.5% of the first $1 million of your sale, and a discounted rate of 1.25% on anything over $1 million. So that's a one-time fee, non-recurring. And one of the objectives of the DST is that the legal fee actually gets paid back to you based on the performance of your investments, because when we treat it as an expense of the trust, one of our goals is to return that money back to you during the course of the term of your note. And so if I sold for $1 million cash, but I paid, let's say, $15,000 in a legal fee at the close, that means the trust really only starts with $985,000, right? But we're going to give you a promissory note for $1 million. And we're going to work with you on how you want the trust to invest those proceeds, because we want to return that $1 million plus an attractive rate of return over the term of your note. And that's what we're going to do when we work with you. So that's really the legal fee. Then ongoing, there is a trustee fee that's earned and an investment advisory fee. We operate sort of on a tiered AUM, or which stands for assets under management system, where our fees go down based on the amount of funds that are coming into the trust. So at the worst case scenario, we're talking about net proceeds coming out of your transaction into the trust of up to $2 million. You're looking at somewhere between 1.1 to a maximum of 1.5% annually based on the assets under management. Depending on the size of your transaction, or maybe you have multiple sales over time that you're going to use the DST from and just add to the DST that is created for you for your first transaction, because there could be multiple. And that certainly happens with a number of our clients. But the total annualized fee could be less than 1% in total. And so again, our fees are very reasonable, and they're structured to give you the greatest opportunity to make a good return for yourselves, whether it's income growth or a combination of both. I mean, you would spend 1% to 1.5%, just working with a financial advisor in most cases. Think about your transaction costs. When you're selling real estate, transaction cost could be 6%. When you're selling a business, that transaction commission could be 10%.
Right.
It's a transaction, one and done. It's over. Here you might spend 1.25% to 1.5% for something that lasts and gives you annual recurring benefits as a one-time fee. So it's not just a transaction, we're there with you for the duration. So whatever your needs are, whatever decisions you want to make, we're there to make sure that it happens. So that's pretty much the fee schedule, pretty simple and straightforward.
Yeah, that's and that's great that like you said, with the selling of a business or a piece of property or anything like that, anything can happen. And you don't get to the closing table at the original contract date. That buyer might fall off, and you go back on the market and you get somebody else, and so that way, when someone does the pre-planning, they know exactly what to do. And when the time's right at the closing table, you say, okay, I want to do this, and utilize the deferred sales trust to protect their wealth, and to benefit their family, and to have help to build that legacy.
It really is. I mean, there's tremendous benefits all around, for the business or the real estate seller who's ready to get out, or maybe they're looking for, a real estate seller is thinking about a 1031 exchange, but there's risk involved in the length of time you have to identify replacement property, and the length of time you have to close it, and what the suitable replacement property looks like, because there's definitely a formula for how this all works. You might bring the DST in and put us in the back seat with you, as a backup strategy. Sometimes that happens where I'm thinking about doing a 1031 exchange, but I can't find the ideal replacement property in time. We could use the DST to park the money and wait for the right opportunity, because you can reinvest back into real estate. That's fine. But maybe you want to do it on your own timeline. Maybe interest rates are too high, and maybe the real estate market's going to drop, you think, in the next year or so. And I don't want to buy back into the same market that I just sold out of. Maybe the DST could be that vehicle for you. What if you're in an exchange, you find property, but then you start inspecting it, you find out, there's some problems here. I don't want to deal with this. How do I get out of this thing without paying the taxes? Your DST is sitting in the back seat. You want to put them in the front seat? We can help rescue you from a failing 1031 exchange. So there's a myriad of flexibility for that. From a business broker or an M&A professional, I mean, being able to provide a solution to a big problem that all of your clients are facing, where none of your competition is really savvy to this yet, that can really put you in the driver's seat to really help more people. We've got a kind of a joke or saying around here. It's like, when I'm talking to prospects, people that are selling their companies, selling their real estate, and I'm just like, what, we should become friends, because we have a saying around here: friends don't let friends pay taxes. Just that simple. Friends don't let friends pay taxes. So that's what we're focused on. We're focused on helping you live your most desired lifestyle, because you're not diluting your equity, you're not diluting your nest egg. Having that extra money working for you means that you can take less risk when you reinvest the money to get the same type of return, right? Because you get to keep all the money and it's all yours. You can take it whenever you need it. Be smart about it. We like to provide you with the opportunity to live your best life. And I think helping with tax deferral allows us to do that.
Just in my experience, let's say, humans are curious critters and they like to find the quote unquote shortcut, or maybe somebody else who's doing this, and everybody's guilty of like going on YouTube, like type in YouTube and type in deferred sales trust or what have you. What would you caution people when they're watching videos from other folks and they're like, okay, this looks interesting. I'm going to contact these people. What would you caution them about?
Well, the deferred sales trust, as I said earlier, it's very specialized and very unique. You know, what you really want to make sure that you're doing is working with, you know, somebody who's bringing this opportunity to you that's educated about this and knowledgeable. Number two, we have thousands of people around the country that are part of our estate planning team, but there's only a handful of trustees. You got to be connected with the trustee, because next to the tax attorneys, that's the people that are most knowledgeable about this. These are the people who are going to shepherd, guide, and coordinate all the steps and the activities that are part of your sales transaction as it relates to the tax deferral side. So I'm a trustee, obviously, for example. There's only 16 people in the entire country that serve in the role that I serve in. So you want to be connected to a trustee because that's going to be one of the most important people. But we have teams, you know, like Nathan and I, have a team relationship going on. So when he's representing sellers and other folks, you know, he's got the solution here, and he brings my team, myself and my team in, and we try to craft and create the environment where the client, you know, can see that this could make sense for them. And we're the first ones to tell them if it won't. Believe me, if it doesn't make sense for you, we're going to be the first ones that say that doesn't make sense for you. But if it does, you know, then we're going to guide and shepherd this in. So anybody you talk to about the deferred sales trust, you're talking to the same family. There are no other companies offering some version of what we do. So, you know, you may want to shop us. You may want to find people that you like, you think you could work with, and that's okay. I mean, I'm fine with that. But we're all going to be part of the same family. So, you know, just make sure that, you know, work with the people that are introducing you to the subject matter. And if you like the folks and they think that they're can do a good job for you and have your best interests at heart, that's the most important thing. And if you feel the need to talk to somebody else in our family, you know, God bless you. It's fine. You know,
Right.
we just want to be friends, because why?
Friends don't let friends pay taxes.
Exactly right. Exactly right. Thank you, Nathan.
Amen to
Good
that.
setup. Good setup. I like that. Okay. All right. What else is on your mind? Timeline. Timeline's a good one. So when should the DST, when should you be talking to us? So really, that's kind of flexible too. Mechanically, we only need like 10 days to 2 weeks in advance of the close of your sale for us to get in place everything we need to and not hold up your closing date, right? But what is it probably better for a seller to kind of get with us and start getting educated on how this works? Usually we've got that class of people that are, before they even put the sign in the ground, I'm not listed yet, I'm not for sale. I want to kind of chart the next path. What's the next chapter of my life looking like? You know, how do I contemplate, you know, the tax component or other things, or what I want to do in retirement, whatever it may be. So we're talking to people before they even listed their property. We're also talking to people after the property's on the market, after they've gotten LOIs or sales and purchase agreements signed, or they're in escrow. You know, so that whole timeline is appropriate. So if you're an advanced planner and you want to learn more about this and how it affects you personally, before you even elect to put that asset up for sale, great. But what if you've already accepted an offer? Is it too late to plan? No. As long as we still have 10 days or a couple weeks in advance of that closing date, we can still help you. So it's very flexible when you get it. What if you're thinking about doing a 1031 exchange? You might want to learn about this before you sell the first property, because you might want to ask us to join you in the back seat of the car, you know, while you pursue that 1031, you know, and see if that's the right decision for you. But if it turns out not to be, then, you know, we're your passenger. We can help you out. Right. So timeline is good. Mechanically, you got that, but, you know, we'd like to be, you know, helping to work with you as early as you know, learn about this.
Right. Okay. I guess just to kind of wrap up a little bit, The DST is, nothing new. It's been around for many years. It's you guys have been audited and audited and audited. You've been peer reviewed. So you've got that history behind you. That's one thing that a lot of customers worry about. It's like, oh my gosh, what if I get audited? What if I'm passed away? I'm no longer with my family, and do they have to worry about being audited? That's a big safety feature too. Is just that other peace of mind, being like, okay, I do this, I do it the right way. I'm with the estate planning team. They've got my family's back. That's, to me, and to a lot of folks, that's, sometimes that's hard to find now. Where if you do just like, boop, see ya.
Yeah, no, we're there. I mean, it's not a transaction, it's a service. We're there with clients every step of the way, even after the sale. So leading up to the sale and it closes, we're still there. We're interacting on a regular basis with our clients. We're doing typically quarterly reviews with them, but we're available at any time they need to talk to us, or they have a request, or they need, something changed. We're always there. And so I'm walking and talking with clients every year, all the time. People that have been with me 5-6 years, we're still talking on a regular basis. And so, yeah, it's good to know that we're there if you need us. We're having regular communication with you, and supporting your life and your lifestyle needs, and those of your designated heirs, children, grandchildren, that are going to benefit from this. So, yeah, that's why we want to be friends, right?
Yeah, for sure. Friends, because friends don't let friends pay taxes.
I can't say that enough times, and I'm glad you're saying it too. Yeah.
Yep. And people like to be treated like a service, not a transaction. They don't want to be, a one and done. You're not going to convenience store buying a soda. This is something that has lifelong implications.
Yeah, no, I mean, this is a relationship business. And so you're going to get maximum transparency from us, because we're going to have an ongoing relationship. That's part of what we're doing. And
Right.
so, we're going to try to make sure that we treat you like family. We're very transparent about what we do, because we're going to have an ongoing relationship, and we want it to be the best it can possibly be. Right. And so that's kind of what's in it, for us. And, and I would encourage anybody here, Nathan, I know you're going to have this on your website and all of that, but if you want any specific information about how this might help you or benefit you, I'd encourage you to reach out to Nathan initially, because he's the tip of the spear, in terms of helping folks in his area of expertise and his geographic area as well. Nathan, you want to give us give everybody your phone number, your email address for what it's worth, and but we can all get connected and do an analysis on any pending transaction that you might be contemplating.
Sure. And after this, there will be a slide up with both Greg and I's contact information. I can be reached by cell phone 423-429-1088 anytime, pretty much. If it's late or early, I'll leave me a message, send me a text, and I'll get back to you as soon as possible. My email address is nathangeorgeconsulting@gmail. And I've got that to my hip, and as soon as feasible, I will get back to you with the appropriate answers to your questions. And Greg and his team, they're on the ball too. Anytime I send them an email, even though they're on the West Coast, they'll get back to me within that same business day, or within the morning of the next business day. So nobody's left hanging. Everybody's great at communicating. We all have a common goal of helping everyone pay less taxes, to building wealth for their families, protecting their blood, sweat, and tears that they've built their business, or whatever your case might be. That way you can enjoy your retirement, you can provide for your family, and not have to worry about sending Uncle Sam a big fat check.
Well said. Well said. Anything
Well,
else, anything else that, we need to, bring up for your audience today or,
no, I think that pretty much wraps it up. We've been going a little bit longer than I anticipated, but hey, you could, like we were talking earlier, we could talk all day about this. So there's lots
can
of
do.
ins and outs, and also there's no one size fits all. There's not, it's not a blanket, it's not a hat where you just because it fits Tom doesn't mean it's going to fit Sally. So this is very unique to what your goals are for yourself, and your goals aren't the same as your neighbors, aren't the same as your parents, and things like that. So that's one thing I'd like to drive home too, is this deferred sales trust is built for you. So that's, and to me that's valuable, because nobody likes putting on the same pants as your neighbor.
Yeah, it very much is a customized service. Everybody gets to chart their own destiny, and no two clients are the same. So we don't try to force you into a cookie cutter box. Everybody gets to chart their own course, to chart their own destiny. So let us know, if you have a need to defer taxes, and you want to see if this is a good fit for you. We'd love to, have the opportunity to discuss it with you. And if it works for you, we'll let you know. If we don't think it works for you and it's appropriate in your situation, we'll also let you know that. So at least you'll get your information and enough information to make a good decision for you and your family. That's really our objective when we start talk with any new prospective clients. So, well, thank you very much, Nathan, for having me on your podcast. I've enjoyed it, and hopefully provided some value for people to learn about something that's maybe new or new to them at least.
I appreciate you too, Greg. Thank you for your time and your wealth of knowledge. And I'm sure we just hit the tip of the iceberg today. And if anybody else out there has any questions, don't hesitate to reach out to us. We're here to help, and that's why we're here. So reach out. No question is a dumb question. It's like the old saying goes: if you don't know, ask, and that way everybody will be educated and all on the same page, and see how we can really help you reach your goals.
Well, sounds good. Well, I look forward to our next conversation, Nathan, and for the rest of you, thank you for joining us, and hope to talk to you soon.
Yes, sir, Greg. Have a blessed
All
day.
righty. All right. Bye, everybody.
Bye-bye.